Hey guys, how's it going? It's Andy from MagooInvesting. Happy Monday. Last week we talked about a lot of different stocks. If you missed those videos, I talked about cheap stocks, value-wise, price-wise. I talked about the best dividend stocks to buy and what I thought were some of the best deals going into 2021 on a growth basis. And so now that we've talked about a bunch of stocks that I really like going forward, I wanted to take a step back and kind of explain how I use that information to make as much profit as possible. Obviously, this isn't, maybe not the most profit as possible, but how I get reliable gains. And so if you looked at this title, I'm going to explain what happened with one of my stock positions that left me down 400%, why I'm totally okay with that, and why I'm sitting in 75% cash going into 2021. So we're going to be taking a break today and talking about investing strategy instead of individual stocks. But if there is a stock you'd like me to go over in a future episode, I'm going to be back tomorrow talking about different stocks and giving my opinions on them. So be sure to leave those in the comment section down below. But before getting started, I do have to say that I'm not a licensed financial advisor, and this is not financial advice. Anything you hear in the video is just me giving my own opinions on the stock market, and you need to do your own research before making any investment decisions. Also, if you've been enjoying these videos, I really appreciate it if you hit the like and subscribe button, as it would help my channel out a lot. You guys have been giving me a lot of support recently, and I thank you all for that. So with that out of the way, let's hop into it and kind of explain how I was down 400% on a different position, and I was totally okay with it. So in the overall stock market, there's a bunch of different ways to invest, and I think that's what's so attractive about it. You have maybe some older people that are trying to be super conservative. You buy dividend stocks that aren't going to be returning a lot in a single year, but it's very stable. You can be very aggressive. You can do stuff that you see on Wall Street bets of buying options where you can have huge gains, but it's also a huge amount of risk. And then there's somewhere in the middle, which is kind of my investing strategy. So in today's video, I'm going to explain how I've been using this option strategy called the wheel strategy to be making reliable gains, and the fact that I'm up around 65% in 2020, which is considerably outperforming the market. So this is not a super complicated strategy, but I think people get so intimidated when it comes to options, especially when you see stuff on Wall Street bets of people losing all of their money, which is very common on there. But this is a very conservative approach to trading options, and it's a way to have reliable gains and have a monthly income source. So I absolutely love options, and before getting into it, I do need to kind of explain what options are. Basically, the whole idea of an option is that you are signing a contract with someone else. And so there's two types of options. You have calls and puts. So basically, I'm going to start what it means to be buying a call. The whole idea of buying a call is that you are paying someone a premium for the obligation to buy 100 shares of a stock from that person at a certain price by a certain date. So it's kind of you're paying someone to just kind of hold on to shares for you. And so say a stock is currently sitting at $10, and you're going to pay someone to potentially buy it from them at $11. And so as of right now, it's not at $11, it's not worth anything. But if the stock skyrockets up to $20, you're going to be able to buy it from $11, and that person's going to be missing out on the rest of that profit. So this is how you get explosive gains by not paying that much, because the premium is significantly less than buying 100 shares. But most of the time, options expire worthless. And so what we're going to be doing is going to be selling options. And so this is the exact opposite of Wall Street bets. The category that this is considered would be Theta gang, which is the whole idea is that you're selling contracts to people and pocketing the premium. Because as I mentioned, most of them expire worthless. And what happens when a contract expires worthless? You just keep the money and you just move on with your day. So the whole idea of the wheel strategy is first you have to pick a stock that you absolutely love. And so that's kind of the whole idea of this channel is I identify stocks that I love and talk about the long-term potential of the company. The whole idea behind this is when you're selling options, the worst case scenario is that the stock crashes. And so if you're picking a stock that you have faith in, if it crashes, I'm not that upset about it. So for example, when I started my position on Sonos, it went from $17 down to $13 within a couple days. Was I upset? No, not really. I made a video talking about how Sonos crashed and I was feeling really good about it. And so picking a company that you love and you trust makes it so you're less likely to sell at a loss. So first we identify stocks that we love. Two, you have to pick a stock that's relatively cheap. Someone like myself, yes, I would love to trade options on something like a Microsoft, but with an option, you're obligated to buy or sell 100 shares. And 100 shares at the $200 price for Microsoft, I don't have 20 grand just sitting around to invest. So that's not possible, which is why I picked something like a Sonos, because 100 shares at $15 is $1,500, which is much more manageable than the 20 grand for something like a Microsoft. Number three, it has to be volatile enough where the premiums are worth your time. If you look at something like an AT&T, which is a very stable stock, if it's not as volatile, you're not going to be making as much. And it's honestly probably better, in my opinion, to just buy the 100 shares of AT&T and pocket the dividend. So you have to find a mix of all three, which is the reason why I don't trade options on just any stock I find out there. It has to be relatively cheap. It has to be a stock that I love, and it has to be volatile enough where it's worth my time to put my money on the line, because with an options, you have to have enough money set aside that you could, if the option gets executed, be able to buy 100 shares or sell 100 shares. So it makes it so you can't just pick this with any stock. So it's very limited. So the two stocks that I've done this with recently, Sonos, because it was trading between $15 and $17, and Zynga, which was trading between $9 and $10. So when I started the wheel with Sonos for the first time, you start by selling a put. What this means is that if a stock falls below the strike price, you're obligated to buy 100 shares of that stock from a person. So back on July 1st, I sold one put on Sonos at the $15 strike price for 67 cents. So what this means is if the stock falls below $15 on expiration, I'm going to buy 100 shares at the $15 strike. But the benefit of this is that you're also pocketing the 67 cents a share. So if the stock falls to $14.99, yeah, it looks like a loss because you have to buy the shares. You're still at a profit because you got paid 67 cents per share. So while the stock was at $14.99, your average price would be $14.33. And so it just lowers your average price. And that's the whole idea of it. When I sold this, there were two different scenarios. If it's above $15, nothing happens. I get to keep the $67 of premium and move on. And so the other scenario is it falls below $15, I buy 100 shares and I also get to pocket the premium. For this example, it stayed above 15. So I just pocketed my premium and did it all over again. So this is what I mean by it's kind of a flow chart. So you sell a put and then you have two different options. Did you get assigned? No, do it all over again. And so I did this another time right before an earnings report. And so what happens during an earnings report is that the volatility spikes, because with the expected move from an earnings report is a lot more than just the daily move. And so what happens there is that the premiums are significantly higher, which is a great time to be selling options. So what I did next was I sold a Sonos put for $17.50 for 1 month, and I got paid $2.15 a share for that, which is a huge premium. So I was very happy with that. And so what happened is that Sonos had poor earnings and it tanked. So when I sold that put, it was currently sitting around $17 and it fell down to $14 within a couple days. So I had to buy 100 shares of Sonos at $17.50, but I was paid $2.15 for it, making my average price $15.35 instead of the $17.50 if I just bought in at that point. So now we're back to the wheel. So we've identified a stock that we liked. I sold a put, and then you have the two options. Did I get assigned? Yes. So now I have 100 shares of a stock. And what can you do with 100 shares? You can sell a call. Okay, so now we're going on to calls. And so now we're going to be selling a call, and the whole idea is that the stock is above that strike by expiration date, you're obligated to sell. And if the stock stays low and it does not get above that, you pocket the premium, lower your average cost, and you just keep doing it over and over again. And so this is how I ended up lowering my average price on Sonos significantly. I'm going to put up the graphic, which the chart, the blue stuff is the Sonos price and how it's changed over time. And then the orange is my average price across time. And so Sonos was pretty horizontal for a long time. And so all of my calls expired worthless. And so I just kept selling it and lowering my average price. And so this seems like it's too easy, right? Like I lowered my average price, I got paid for it, and the stock didn't really do much. And so we're going to talk about how I was down 400% on a position. So going into the earnings report, the stock was sitting around like $14.50. Then it had some huge moves to the upside. But I'd already sold a call at the $15 strike. So what that means is I'm obligated to sell at $15 no matter what the price is. And so going into the earnings report, it spiked, and now it's currently sitting above $20. And so this is how I ended up being down 400%, because the 400% shows that the option that I sold is worth 4 times more than what I originally sold it for. So if I bought it back, I'd be down 400% compared to the capital that I made from it. So this was a huge loss, but it's not actually what happened. So I sold for $15. My average price is down at $12.40. So I missed out on a huge amount of upside. But for a stock that was going horizontal for a long time, I felt pretty good about this. So now I kind of want to talk about the pros and cons of the strategy, because for a while it seemed like it was almost too easy. Like I was just pocketing the premium, but I did miss out on significant upside. So I want to talk about the pros and cons of the wheel strategy. So just you have an idea of what all the different scenarios are. So the first pro, if you're doing this with a stock you love, you'll be able to lower your average price even if the stock stays around the same price or goes down. So Sonos was a stock I was happy to hold for pretty much ever. And the fact that I was able to keep lowering my average price, very attractive. Pro number 2 is you're able to get consistent profit on a weekly or even a monthly basis. And so when you're holding a stock, you don't actually see that profit until you sell. The opposite with selling options, that you're pocketing the premium, which is kind of like a dividend. So you can use this to generate cash flow to buy different stocks. You can take it out and use it to pay for bills. I know plenty of people that do this on a regular basis, and they keep using the wheel strategy, and they pay all of their monthly expenses just based off of the premiums that they pocket. So you get consistent profit that you get to use right away. So unlike having to wait until you sell, the second you sell that option, the premium's yours and you can do whatever you want with it. Pro number 3 is it's not that complex. Compared to some of the really complex option strategies, you have the iron condor, you have the iron butterfly, you have a strangle, straddle. There's plenty of different complex options, but this is a very simple way. You're just selling options over and over again. Con number 1 is that this is technically a bearish strategy, because the way that you get to pocket the premium and you don't miss out on the upside is if the stock stays low. And so what we know is that the stock market on average returns 10% a year. If you're picking some of these more volatile stocks, 10% move isn't unheard of. So you do miss out on a lot of upside potential because you're kind of betting on the stock to stay low. Con number 2, as I mentioned, you miss out when the stock skyrockets. This was the huge reason why I missed out on a lot of profit with Sonos, because I limited my upside potential, because if it went up above $15, anything above that point, someone else is making money off of me. So it really limited how much potential I can make. So Sonos went from $15 to $20, and I was forced to sell at $15. So this really limits your upside potential. And then the final con is that if the stock tanks, you are stuck holding the shares, because you sold an option to buy for, if it's a put, if it falls below a certain price. So say if I sold a put at 15 and the stock fell down to 10, I'm gonna have to be buying at 15. So this is the importance of picking stocks that you really trust, because it's not unheard of for stocks to miss on earnings report and fall 15, 20% at a given time. So overall, this is a very conservative strategy when it comes to options. This isn't something where you're going to be buying an option, have it double, triple in price within a couple weeks and make huge profits. But it's also conservative in the fact that you're never gonna blow up your account. This is not something that I use my full portfolio on. As of right now, around 30% of my portfolio is long-term stocks, and the rest of it I use for options. So you're never gonna blow up your portfolio using this, but it does limit the upside potential. But if you can do it consistently, I think this is one of the most attractive ways to bring in consistent profits that you can do whatever you want with. You're getting the premiums, you can buy blue chip stocks if you want, you can use them to pay off bills. You have so much flexibility when it comes to this option strategy, and I think it's the most attractive thing out there. So at this point, I am sitting in 75% cash, because this was a huge part of my portfolio, and since I sold, all that cash is just sitting on the side. So I'm gonna be looking for more plays and try to get into another wheel strategy. I could go back in with Sonos if I really want, or I could find a different option. Right now, I'm currently looking at GE as a potential option, because I think it has a lot of upside potential, and the premiums, they're decent. They're not amazing, but they're not horrible. So let me know what you guys thought about the wheel strategy. Have you ever sold options, or are you more likely to buy options? Let me know in the comment section down below. I'll be back in tomorrow's video talking about just a list of stocks, but today I wanted to explain how I was down 400% on one of my stock positions and how I wasn't that upset about it. So thanks for watching. I appreciate all support, and I will see you tomorrow.